Welcome back to our tutorial about financial modeling on Android using Kaluta projection methodology. We ended up summarizing our projected financials. To recap, let us go and see what we did with our two transactions of sales and cost of sales that were used to balance our financials. With sales, when you make a sale, and in this case we have assumed it is a cash sale, so you debit cash and you credit sales. So in the cash flow sheet here, the sales have been debited as cash sales. And in the profit and loss sheet here, the sales account has been credited. Okay, so that is the double entry transaction for sales, which have been captured in cash flow and profit and loss statement. Now, let's see for the cost of sales. As I said, all the purchases done in a month have all been sold. So the cost of sales is equivalent to purchases, cash purchases. And for that matter, when you purchase by cash, you debit purchase account and you credit cash account. So in the cash flow sheet here, cash purchases are here reflected as credit, negative. I will format these numbers so that the negative numbers should appear in red so that we can see. I'll do that after this explanation. So the purchases have been credited in cash to draw out cash and debited in profit and loss account in cost of sales, because the purchases, when we purchase cash, we debit purchases, we credit cash, and then when we sell, those purchases are transferred to cost of sales. So here cost of sales in the profit and loss account, because the purchase account is zero now, because all the items have been moved to cost of sales. So those are the two transactions that were captured in profit and loss account and in the cash flow. And the balance in these two accounts, in the profit and loss account, the balance is in the profit after tax. So the cumulative figure of it is reflected in balance sheet as retained earnings. So in the balance sheet side here, on the retained earnings sides, we have that cumulative profit after tax at the end of each period. In this case, at the end of each month is reflected in balance sheet. And in the cash flow statement also, cash flow at the end of the period is the one that is captured in the balance sheet and reflected here as cash, as you can see in the current assets, as cash at the end of the period. So those are the two items that have been captured in the balance sheet as stock items at the end of the month. You know, balance sheet is a stock. It captures the information about accounts as at a specific date. Okay, where profit and loss is a flow statement. It just accounts for the movement of items during a specific period of time, in this case during a month. Okay, so that's the difference between profit and loss and cash flow statement, which are which are the flow statement, and balance sheet is a stock statement, a snapshot of transactions as captured as at a specific date. So I have started with two transactions only for a reason, in order to enable you to have a big picture of how the financials are interacted or prepared seamlessly using Excel, so that you can see it through, because you only have two items to take them into the financials. So this one helps you to get a bird's eye view of how to model financials seamlessly. And it is seamless because, for example, if I change the price per unit here, instead of 600,000, I put it 800,000. Let me So I put 800,000 instead of 600,000, and this is throughout the projection period, including adjusting for inflation as we did. So that change will be reflected in the sales, in the profit and loss, in the cash flow, in the cash sales, and in the balance sheet too. It will be reflected, and as you can see, if go to the check, our balance sheet still balance, because our financials have been seamlessly interlinked using Excel formulas. And this is the beauty of using Excel, because you save a lot of time that is not possible when you do things manually. Okay, so that's it for recap. Now let us go to do some more stuff now, introducing more stuff now, after you have a big picture of how the financials are seamlessly interlinked during projection period. Of course, this one we are doing for projection, but you can also apply it in the actual financials. If you want to capture them in Excel sheet, you can still follow the same principle, so long as you know where something is debited and where something is credited. You can keep on doing that and go and input those transactions directly into the financial statements instead of going through the ledgers. Of course, this one is not advisable for accounting, because you need to follow all the procedures for accounting, but this is for financial modeling projection. Okay, so now let us introduce stock. In this business modeling thus far, financial modeling, we have assumed that all the purchases done in a given month is sold all in that very same month, so we don't have closing stock. Now let us introduce the stock component into our financials. To do that, I go here to the cost of sales, and I can insert here some rows, and then go to this sheet here and then insert rows. So I'm starting with opening stock, and then followed by purchases, and opening stock plus purchases, you get goods available for sale, goods available for sales. And here I will put closing stock, and then after putting closing stock, then my cost of goods sold here, which is already here. This one is computed, okay, by taking 70% of sales. I leave this as it is. So let me just delete these extra rows here and go to here to the sheet, delete rows, so this one is cost of sales, which is in this case 70% of sales. Okay, now as I said, opening stock plus purchases is equal to goods available for sales. So I'm putting a formula here. Let me put 0 here so that I can use sum, and then go to sum, auto sum, that and go. So opening stock, add purchases, we get goods available for sales, and then we have closing stock. Closing stock for a previous month is opening stock for the next month. So I put a formula here on the opening stock. I put a formula here by using equal signs and then pick on the closing stock in the previous month as opening stock, and I can fill this to be true the rest of projection period. So let me fill this first. Then after that, goods available for sale, we have the formula here, so I can fill it also because it is true throughout the projection periods, the same formula. And then closing stock. Now we have we need to derive closing stock now. We know goods available for sale minus closing stock, you get cost of sales, okay? Or let me do this one. Yeah, we can just give example here, saying gas, goods available for sales, plus goods available for sales minus closing stock equal to cost of sales, cost of goods sold, okay? Now, if I want to get closing stock, just a matter of rearranging this mathematically. If goods available for sales minus closing stock is equal to cost of goods sold. Now, if I start with closing stock in this formula, closing stock will be equal to closing stock. That means I'm taking closing stock and I move it to the right of the equation, and because closing stock is minus, it is now positive closing stock. When I move it to the other side of the equation, it has become positive. So closing stock is equal to gas, that one, gas, goods available for sales, minus, because now cost of goods sold is moved to come to the gas side, okay? So closing stock is gas minus cost of goods sold. Cost of goods sold. So I'm putting that closing stock is a derived figure now here, that in order to get closing stock, I will have to take gas, okay, and then minus cost of goods sold. I say closing stock equal to gas minus, here I wanted to put minus so that you can follow the minus CGS. So to put a formula for closing stock, I take gas, which is here. Let me put a formula here by starting with equal sign. Starting with equal sign. So closing stock equal to gas minus closing stock. So gas, this one, minus closing stock. Now closing stock equal to gas minus cost of sales. Cost of sales is, in this case, is B18. Let me just type the number, because B18, sell, enter. Okay, so that is my closing stock, and this one I'm going to fill it to the rest of projection period because it is going to be true. Then after doing that, I come to the purchases now, okay? So far, the assumption we have is all purchases are sold in the same month. So in this example, our purchases is equal to, as we said, we are purchasing, and put an equal sign, we are purchasing this sales value times 70%. That is the cost of our purchases. So this is what we were purchasing during the month. This is as per. So I can fill this to be true the rest of projection horizon. So far, this is what we have modeled. The only difference here is now in our profit and loss statement, instead of picking, in our cash flow, instead of picking cash purchases from profit and loss, as you can see the formula there, from profit and loss. I'm now going to pick my cash purchases from the purchases column in the working sheet, okay? But the effect will be the same because the assumptions are still the same. So I put an equal sign, let me edit here, and then go to put an equal sign. Oh, sorry, it has not taken off the earlier one. So equal sign, and then put a minus figure because purchases are drawing out cash, and then click on the workings and then go to purchases column, that is B15 here in the January, start from the January, and then enter, and then I can drag this now fill and drag this throughout the projection period. So we have just changed from picking from the profit and loss we did earlier for demonstration of how our two transactions will be input into our financials, and now we are using a detailed accounting of inventory, so we pick it from the purchases element, okay? And after doing that, we can go and check our balance sheet to see if it is still balances. Yeah, check. You see the check is still 0, so our balance sheet has balanced. There is nothing that has changed, okay? But the changes are coming now with the new introductions that I'm going to do here, okay? Normally, you don't buy exactly what you want to sell during a specific period of time, in this case on monthly basis. You will have to add a buffer stock just in case, okay? So you will have a buffer stock. Now, instead of purchasing exactly what I'm expecting to sell during a given month, I will add a 20% markup to act as my buffer stock. So in the purchases here, I change the formula. Instead of putting only 70%, I click on the formula and then I multiply by 1.2. That is to mark it up by 20%, okay? So I click enter. You can see now my closing stock has been reflected immediately. There was 0 in the closing stock. Okay, let me demonstrate that. If I remove this 1.2 and remain with the former, you see the closing stock is 0. But after adding 1.2, then I've got the closing stock figure. Now, that is the one assumption. So, if I can put a formula here to demonstrate what I want to do, say I want to say that stock divide by purchases. What do I get? Let me put it into percentage. Oh, sorry. Maybe I should increase the decimal numbers here and put it on percentage. So I just want to fill this you see to yourself, what is percentage of my purchases to stock? If I remove the two decimal places here, oh sorry, let me fill this with the rest. So you can see my closing stock figure is always the same. This is not proper because my purchases are determined by my expected sales, and you can see my purchases. Let me freeze the pane here so that I lock the column for particulars and the rows for year and months so that we can easily see what is going. Freeze pane. So you can see my stock is always the same while my purchases keeps increasing as expected sales increases. That's why you see the percentage keeps on going down here. Percentage of stock on sales. Now my intention is to have 20% of 20% markup on my expected purchases during the month, as I did it here. 70% I multiplied by 1.2. So this one I'm going to fill it because it is going to be true throughout the projection period. So I fill this. So that my purchases is added with a mark of 20% on top of expected purchases. So it's going to be true throughout. But you can see my closing stock figure also changes. Though my purchases now actually reflect. For example, if I click here, you see the formula there. It is value times 70% plus multiplied by 1.2. That is marking up the purchases by 20%. So purchases in any row you will go here, you will see that it is okay. But because I have an a closing stock here, this figure is going to be added on top of the 120. I mean 20% markup I put here in the next month here in the next month. If you come here, I put 20% markup by multiplying by 1.2, as you can see in the formula bar there. Now I want to remove this closing stock of the previous month so that I have exactly a 20% markup on the current month purchase expectation. So I click on the formula bar here, and then I put minus closing stock in the previous month, this one. So that one is going to be my new formula, and I drag this to be true, so I feel this one to be true throughout the planning horizon. What did I do? Let me repeat again there. Something is not proper. Okay, so this one, fill, and then use the fill handle to drag this to the end of projection period. Now after doing that, you can see now my ratio of stock as a percentage of purchases has always been consistent. You see, it's always almost consistent. So this is exactly what I wanted to do. Now after doing that, then I want to incorporate these changes in my financials then. So starting with if I go to balance sheet, you see already there is, if you see the check, there is the difference there. So this is what we want to settle. So coming to the cash flow, cash purchases, here I picked them in the workings B15. Which is here. Yeah, okay, so that's right. Cash purchases. In the balance sheet, now we have introduced a closing stock. So here in the current asset, I add closing stock. Closing stock component. And I put equal sign and go to my workings and go to pick the closing stock figure for January, which is here, enter, and then fill this to the rest of the projection period. Okay, after doing that, let me see if my balance sheet has balanced. You see on the check, it has balance. Why? Because I have introduced another item that is closing stock, and the same has been reflected in the balance sheet as a figure of stock as at the end of the month, and everything is now done. Okay, so this part was to give you a recap of what we did in the lesson 2 and to introduce stock. There are various ways you can do. For example, in this case, I've assumed that I'm purchasing 20% more of what I'm expecting to purchase on a monthly basis. Sometimes it may be you don't have to purchase on monthly basis. maybe you need to purchase after every 3 months, because probably you are ordering from abroad, and it takes time for the products to move to your country. In this case, it's Tanzania. Okay, so instead of putting purchases on a monthly basis here, for example, let me delete all these purchases we did. This is for illustration purposes only, but we will remain with monthly projections as I said, as I projected here. I mean monthly purchase of our smartphones. This is, we are assuming that we are just buying them from the wholesaler here in Tanzania, so we don't need to purchase more than a month. Just a month is enough. But if I have cleared it to just demonstrate another case. Now, as I said, our sales are expected to start in April, and we have cost of sales. So if I expect to purchase after every 3 months, I can put for April, I will have to say that here in March, the stock for April, May, and June should be there. So I can put a formula here. And say equal to this closing stock, I mean cost of sales for April, plus for May, plus for June here. Okay, and after that I can put brackets here. Oh, sorry, I'm doing completely another thing here. Let me repeat again. Sorry, let me repeat. So that one was picking for, let me enter it first. Enter. And after entering, that is purchases for expected sales for the period of 3 months, as I did. And let me click again here, and then now I can go to the beginning here, put a bracket, come at the end here, put a bracket, and then from here I multiply by 1.2, okay, so that to provide a markup of 20% in addition to what I expect to sell for the 3 months. So this is what I'll purchase, and the purchases needs to be paid here. It needs to be paid somewhere before, but in March, this is actually we are recording our purchases. So after recording these purchases in March, then I can copy this. This formula, and then which covers from here covers for April, May, and June. So another one will be here, so I paste there, I paste there, and this one, as you can see, it covers H18. If you go to the formula bar, H18, that is cost of sales for July, I and J. For July, August and September. You see, so I can be pasting this after every few steps. For example, here 1 2, the third one I pasted. So the same principle I'm using. 1 2, the third one I paste that formula. I paste that. 1 2, the third one is paste the formula. 1 2, third one is paste. Or I can just go back here, then go back here, starting from here, select all these stuff that I've been doing up to here, and then copy again, and then 1 2, here I paste, so that to paste multiple times to save time. Okay, multiple times. The same 1 2, I come here, I paste, paste, 1 2 3, come here, paste. So I'm done with my projection period. And this fact, if we go to cash flow now, we will see cash purchases is done on March, and then no purchases, then again on June, and so on. Let me, as I said, let me from cash sales here select all this up to here, and then go to the end. And then on home here, on 1 2 3 on the numbering, I go to this should be in the number, so I click on the number, and negative numbers format, I select this red one, the second one here, so that you can see the red account. But I also need comma separator, and I need to remove two decimal places, so I click on this one twice to remove the decimal places. Okay, I left one okay, let me pick again here from here, and then cover all these periods, and then select this one, and then number, negative number in this format. Okay, so This is just to show you. In the purchases now, you see we are doing purchases on March, on June, on September, not on monthly basis as we used to do in the previous because of the new assumptions. And if we go to our balance sheet, you see the balance sheet still balances because the changes we have done have been properly reflected in all the transactions about purchases, cash, and stock. All of them have been incorporated into you can see the figure for closing stock here increases. Okay, so as I said, this one was just to demonstrate, but for the purpose of for this exercise, let us just remain with the same assumption of monthly projection, monthly purchases. So I'm going back, sorry, I need just to come here, and then purchases here will be not in this month, so let me delete each and everything here in this column. Let me delete everything here we did so that we go back to our earlier assumptions of purchasing monthly, because we are just purchasing them from a supplier, wholesale supplier here in Tanzania, so we'll be purchasing monthly. Of course, if you purchase in bulk, you need to have a place to store them, security, and a lot of stuff. And these smartphones, they may be going with trends, so having large stock may not be appropriate for you. So let us go back to our earlier assumptions, which were on monthly basis. So from here on April is where my purchases will be done, and I put the formula back again, which is equal to this cost of sale, the value, so that is the sales value, multiplied by 70%, and then multiply by 1.2 to gross it up by 20% margin as a buffer stock. Okay, and here in the coming month, I'm copying, I just fill this one again here, but I need to adjust this one to remove minus this opening, this closing stock in the previous month here, as I explained earlier. And this formula now is going to be true throughout the planning horizon. So we are back again to our monthly projections, as you have seen. Well, so I don't need these, I just select this area here, this area up to here. I don't need this, so delete. Those were just for demonstration purpose, we don't need them. So my balance sheet should have balanced but after making those changes. And for this tutorial, let us end up here. and we will proceed with other items in the coming lesson. Thanks for listening. Welcome back in the new lesson that is expected to be posted tomorrow. Subscribe to my channel so that you get notified of these pieces of projection tutorials so that you don't miss a thing. My friend, I can assure you, search the whole YouTube. You will never find a tutorial that gives you this much knowledge and experience in the real world of financial modeling. You just see short videos of people trying to demonstrate their academic skills in financial modeling, but they can't model real-world financials. Here you are with an expert in financial modeling since October 2010. I've been doing this business and I have been developing this methodology brick by brick. So go east, go west. Here is where it is the best for you to learn financial modeling using this Kaluta projection methodology. Thanks guys, see you next.